Now, without further delay, let's begin today's event. Again, sponsored by WNS and hosted by American Banker. I'd like to introduce your moderator for today, and that is Jim Erickson. Jim, you have the floor.
Thank you. Hello, everybody. Welcome to our session today. We're really glad you could join us. I'm glad to be here. We're talking about creating an efficient commercial lending value chain through right organizational frame. So today's discussion, which I've really been looking forward to, is about organization structure and processes within the organization more than about technology directly. So this is an area of great interest for me. Real briefly, my name's Jim Erickson. I'm your moderator today. I was formerly the founder of Information Management Magazine, Business Intelligence Review, and so forth. But I also have a background in process. It's really an area of interest to me, and business organization structure. Architecture is also very interesting to me. So we have a great distinguished panel today who are going to weigh in on some of the benefits and challenges and give you sort of a good kind of a framework and structure for tackling this in your organization. Really glad to have this great panel of speakers with us today. First of all, Sean Timms, who is the Group Vice President for M&T Bank. He oversees the bank's loan analysis department. He leads a team of managers and credit analysts responsible for all the commercial real estate, C&I, and specialty underwriting activities at M&T Bank with credit exposure above $10 million. We are also going to be hearing today from Bob Zeller, who is the head of the banking group portfolio management at KeyBank. His group is responsible for underwriting new loan opportunities, managing a portfolio of loans in energy, leverage finance, asset-based lending, diversified middle market, business banking, a wide range of portfolios under his supervision. And you're also going to be hearing today from Utpal Sengupta, who is with WNS. He has 13 years of experience in corporate commercial banking space, working in creating domain-led transformation, policy-driven solutions across clients in different geographies. He transitioned, set up multiple teams and services globally for clients offshore, like leveraged lending, asset-based lending, equipment finance, underwriting and portfolio, monitoring support, and SME and large corporates. So you can see we have a great panel of boots on the ground experts today you're going to hear from. As Marvin mentioned, we are recording this session, and we will give it to you in the link for playback later on to share with your colleagues or review. You can download the slides later on today on using the resources tab at the bottom of your screen. And as Marvin mentioned also, we're having a question and answer session at the end. At any time you can enter questions, and we'll be sure to try to get to as many as we can today. Whatever we can, we're happy to follow up with you. So I'm going to move us along and try and get us out of the way. But first, I'm going to ask you one of two quick polling questions we're going to have today. There's just two of them, so we won't bother you too much. But if you could answer the following here, give us a sort of a level set. Which is the biggest process structure challenge you face in your organization? So if you could select one of these, please. Is it about turnaround time, too many people-driven processes, too many administrative tasks, non-standard processes, duplication, or is it about the record and no single version of the truth? So if you could quickly do that and hit that submit button, I'll be able to kick things off with our really distinguished panel today. I'll give you just another second to do that. Don't forget to ask those questions. I'm taking notes, and I'll have some questions of my own, I'm sure, too. So I'm going to go ahead and close that poll. Okay, well, looks like we have a good mix of responses here from our audience. No single version of the truth. Looks like along with too many administrative tasks, and I think that's going to fit right in the sweet spot of what we're going to talk about today. High turnaround time, absolutely. Non-standard processes, you bet. Okay, well, let's get started then, and let's talk about some of the typical challenges for commercial banking departments like the folks on this call are facing today. And I'm going to toss things over to Utpal Sengupta to get things started with our panelists. Utpal, could you talk a little bit about some of the challenges like our audience was just commenting on just now?
Yeah, sure, Jim. Thank you for that. So, truly speaking, before we going into this typical challenge, if we just take a step back and try to understand that why banks face these kind of challenges, that is actually very important to understand. What is the reason behind it? Actually, if you look at a journey of a bank, maybe a bank is starting as a community bank, becomes regional bank, then goes for national, then becomes a global bank. During this entire journey, it goes through so many changes. So something like be it acquisition of a new entity, or maybe acquiring a portfolio from a different entity, trying to enter a different sector, a new sector, trying to do business in a non-traditional way, implementing maybe new tools and process in the bank. Actually, this list can go along. It can be an endless list. But the point which I'd like to note here that these changes do not take place consistently across the bank. May not be even in a single region or may not be in a single portfolio. So when we are not implementing these changes across the portfolio of the bank, this actually leads to all these challenges. So as you have seen that non-standardization of data or the absence of single version of truth, those are those kind of challenges where everybody deals with. So if you, let's say, if you're a part of sales, when you're trying to cross-sell with your existing customers, you do not have a single identifier which actually links all your database, all your systems, your system that is speaking to each other. If you're part of credit, so on a single page view, you cannot see, you cannot understand that where the risk lies. You cannot get your EWS or RD signal. So over a period of time, if you see, it becomes a very manual, intensive, and comprehensive task. So that actually leads to your administrative task. So that is really one of the typical challenges. And I like Sean to share his actually experience from his bank. What kind of challenges, Sean, the bank they are facing?
Yeah, sure. Thank you, Utpal. So some of the challenges I've faced in my career and here at M&T Bank really, I think, relates around the separation of roles and responsibilities and duties, primarily focused on the RM and the PM roles. We have that creates many challenges, the separation of these roles, primarily in credit fulfillment, client onboarding, and overall customer service. But the challenges really, they differ from CRE to C&I to specialty underwriting. They differ in new money versus annual reviews. And in particular in M&T and other banks is mature markets versus growth markets. They all have individual needs. And not to mention the personalities that are involved. There's a lot of type A personalities, both in credit and the line, that create some challenges. But, some of the challenges I wrote down are the regional and individual differences that exist in the model create challenges. Individual preferences of the RM, they create variability with the RM and the PM role. The one key I've seen over the years really is the overlapping of the responsibility across these roles creates a lot of confusion and inefficiency and complexity that maybe with the right design and the right model, and we'll talk about that in later slides here. The PMs and RMs, those roles in particular, they spend too much time on administrative and operational tasks, so I agree with the polling question. That's something that we struggle with as well. The commercial line often in times is not as focused on the credit monitoring task as maybe the credit function is. The job responsibilities of the PM are also not clear. That creates a lot of challenges. But responsibility assigned to the RMs often become the responsibility now of the PMs. That creates even more challenges. But I would say that the biggest challenge with all these is the multiple touches that is created throughout the credit cycle. And I think that creates frustration, confusion, and oftentimes presents other challenges similar to the ones that are on this slide. But I'll turn it over to Bob and give his thoughts on some of the other challenges.
Sure, thanks, Sean. So, let's talk about high turnaround times, and I'll quickly relay a story from early in my career. When I was a young underwriter, I had spent credit request to a credit officer who was in New York at the time. And I called him and I said, hey, I'm going to FedEx this to you, and then I'm going to, fax some things to you. And he started to laugh at me because he talked about when he was a young banker, he would go out on the road for a couple of weeks by train. He would gather information. He would come back with his analysis, and in a couple of months, he would get back to his client. And I have to wonder what that officer would think about what we have to deal with today when things are coming at us with the speed of the internet. When you think about organizations today, we need to be efficient on how we underwrite our credits, how we process relevant information, get that information to our credit officers so they can make good underwriting systems, quality training, good organizational structure is going to help reduce that back and forth between underwriters, between credit approvers, and it's really going to help our turnaround time to service our clients, because that's what our clients expect today. We're very much a people-driven process, and when you think about who has knowledge of our clients in our organizations, really only a few people, right? It's the RMs, the PMs, and sometimes it's the credit officers. But internally as well, when you look at how we get things done, so much of the time we really rely on what I like to call institutional knowledge. It's guys who've been around for a long time, who know how to get things done, who can navigate the process. Those guys are fine, but people who don't have those relationships and don't know how to do that will sometimes struggle, and that's where good organizations, good organizational structure can really help. Can help those folks. And again, as Sean mentioned, administrative tasks are a big problem. When you think about RMs and PMs, they really are knowledgeable of our clients. They know our clients, they know our portfolios, and so often they're tapped for information, for reporting, for administrative tasks that don't have a lot to do with revenue generating, servicing our clients. And when they do that, it really hampers our ability to grow our.
Great. Okay. Those are great comments. I think they go along with what the audience there is saying. We're going to move along to the real meat and potatoes now of our discussion and talk about, step back and talk about organization design and the significance of organization design. And in a few minutes later, we're going to show you a few different examples, some different models of organization design that you might identify with. So as we go through those, you might want to keep an eye on them and see if something particular there relates to your organization or something you want to ask a question about. So Utpal, you want to talk us through a little bit about this and hand it around with our panel about the significance of organization design?
Yeah, sure, Jim. So what we did here, we tried to come up with what can be the probable solution of those challenges and how that can benefit out for you as an organization. So these are those couple of things which we tried to put together. So Sean, would you like to cover a couple of those, what you did at your part?
Yeah, sure. I'll touch upon the first two slides here, the segregation of duties among the PMRM credit, and then a little bit of the skill base. So, really we're looking at functionally aligning the organization. We're in the process of that now. So this is a really relevant panel discussion and slide deck for me. Functionally align is those four roles of RM being sales driven and relationship driven, the PM role being credit support, the back office we call relationship liaison here at M&T on the servicing side, and then the back office operation. So, each bank is different, I would say, and finding the right organizational design is a couple of slides here. We're going to talk, but no model is perfect, and there's different intricacies in each bank that make it more difficult. But the right design, I think when you come up with the right design, and we'll talk later about how we get to the right design, really should provide clear ownership of the tasks. And then I think more so align those functional tasks with your organizational structure, whatever that is. That gives you the ability to standardize operating procedures from the clarity of the roles and responsibilities, and also gives you the ability to leverage technology to reduce a lot of the manual work and provide a little bit more reliable customer data, as Utpal said in the beginning. We at M&T spent the last year transitioning into the Encino systems operation here at the bank, which has been interesting and challenging, but it's also bringing up a lot of these different roles and responsibilities. The skills-based task really is in bifurcation of these duties and roles and responsibilities. It creates swim lanes for each one of these roles and responsibilities, which is great. More defined objectives and performance measures. And I think people become more proficient at tasks and not spread too thin. My experience is the role of the RM has been challenging over the many years. And as we kind of equate to the new model of technology, especially from the work from home now, where we're relying on technology a lot, it creates challenges. But, when you have the right design, the right model, the right people in the right seats, in the right swim lanes, as we're trying to discover within M&T's re-engineering at the moment, you see a lot of improved turnaround times, as Bob mentioned before, the improved customer and employee experience if you have that right model. The ease, I think one of the biggest things is the ease of issue resolution. So you clearly have roles and responsibilities and accountability. It's reduced the complexity and the rework, the number of touches we have between credit officers, the line, customers, and credit. I think it has also and can, I think, improve the communication across business lines, which is the key. I think no matter what model you come up with, you need that communication. All these I found will reduce the error rates, but increase on the credit underwriting, really increase a better quality control and mitigate your risk. So I think really goes back to really the roles and responsibilities, keeping people in the design and providing them with the support they need in the right roles. But those are some of the challenges and skill-based of a right organization. I know each organization is different, and the creation of that it is a challenge in itself.
Yeah. So thank you for that. And Bob, as I also can understand that KeyBank also has gone for new LMS, loan management system, that is Encino. You are also the earliest stage, you are also struggling with multiple handoff documents. So would you like to share your experience, how you also come across with all those challenges? What are the things you did at your own?
Yeah, so let's talk a little bit about enhanced bandwidth for RMs. We need to find ways to support RMs to really do what we want them to do the most of. And that is client-facing activities. There's somebody at the bank who's fond of saying that if an RM is having an internal discussion, then they're not making us any money. And we need to have RMs interacting with people who can actually pay us and help us generate revenue. That's what we're here for, and that's really what their responsibilities are. And again, it's that clearly defined role. So if we can streamline our organization, streamline processes, reduce administrative burdens, and then deploy the right technologies to help our RMs, reduce the activities that don't help us, but help them do increase the activities that in fact help us grow our business. Credit officers are a similar situation. They are in a difficult position, and I can say that because I used to be a credit officer for many years in my career. But credit officers, when you think about it, they have sort of sometimes the least knowledge of a client, but they're the ones that are actually charged with making that credit decision, right? So we need to make sure that the relevant pieces of data are flowing to our credit officers so they can evaluate that and to make good credit decisions and not spend time sort of re-underwriting credits that weren't properly underwritten in the first place. And then making sure they have all the material data they need to make those decisions. With regard to operational controls, you got to have strong operational controls, and you've got to track, all the way through, booking and funding of loans. You got to track your policy exceptions. You got to track your missing documents. You have to follow up on those things. If you don't, you're going to increase operational risk. You're going to increase credit risk. And I guarantee you'll hear from our internal risk review and certainly your regulators. You know, and Sean talked a little bit about handoff, you know, from one to the next. And, you know, in an organization, it needs to be as seamless as possible. You know, an RM to the underwriter to the credit officer to booking and to funding. Documents need to flow seamlessly and smoothly, and hopefully electronically. That's certainly where we're headed. And you know, we at KeyBank have instituted Encino as well, and not without its challenges. A lot of that.
Yeah, Bob, I think Encino, you know, we've gone from years and years of really a paper-based organization to more of a, you know, even though the challenge to Encino, the transition is tough, it's going to reap a lot of rewards. And I think some of the challenges we just talked about will be mitigated by, you know, the proper structure of the technology of Encino. I think it will make us a lot more efficient.
That's right. And the only thing I'll say about it is, you know, when you roll it out, you have to do the training and you have to put in the work. And if you do, you'll get a good.
Yeah, I agree.
Terrific. Okay.
Yes.
I'll remind everybody on the call to please mute your microphones when not speaking, because we are getting a little crosstalk happening there. Utpal, did you want to add? Utpal, do you want to add anything to what we just discussed before we move into the model structures?
Yes. So the probably what I was just trying to put here, that if you just try to join the dots between all these 6 points mentioned on this particular slide, it will not only actually help you in maintain your expense, the way Bob and Sean highlighted, it will actually create the bandwidth where credit officer can invest their time to strengthen the credit. On the other way around, you can mitigate the risk. So it means you are planning yourself for the future. So if you just think, what's the backbone of a commercial lending business? So ultimately, we are all emphasizing on the right organizational design. That will give you the ultimate strength, and that's the ultimate backbone of a commercial lending business. So by saying that, if we move to the next slide.
I'll go ahead and do that for us. Oops, I went too far. I'm going to go back. Paul, I'm going to let you drive us through these slides. I'll keep my hands off. And remind everybody real quick before we continue, take a note of what we're talking about here and sort of make a mental note, because after Paul talks through these slides, I'm going to ask you about these 3 options. And also, of course, remembering, as our panelists said, there is no perfect option. But see which one of these you sort of identify with or which you think might be problematic, and keep that in mind. So go ahead, Paul, I'll let you drive.
Yeah, thank you. So yes, the way Sean also said that there is no perfect model, there is no particular thumb rule. It's totally based on your organization, totally based on your internal structure. So what we tried to do here, we tried to put 3 options based on our experience when we actually interacted with multiple clients. So on this particular option, which you can see on the screen, so you can see there is a front office, there is a middle office, then we have back office. Front office, obviously it's a relationship based. Middle office, who are the responsible for your credit shop. And the back office, it's more kind of the office and the administrative task. So as we have already discussed that most of the RM and the PM, they are involved in more in administrative tasks. So what we are suggesting in option 1, that all these administrative tasks can be centralized, and that should be put under front office. That can be one of your options. So what we are doing, we are taking out the administrative task from the RM and PM and putting as a centralized team under the umbrella of front office. So if I quickly go to the next slide, which is our option 2.
I'll do that. I'll advance. Oh, there you are. Okay, go ahead. Mm-hmm.
Okay. So the only difference between option 1 and option 2, the centralized administrative tasks, which were part of front office, we have moved it from front office to back office. So back office is taking care of all your administrative tasks. So again, the difference between option 1 and option 2, the administrative task in option was under the umbrella of front office. Now it is under the umbrella of your back office. Now, the last option which we have, that's option 3. So what we did here, so it still stays that administrative task under the back office, but we are moving portfolio manager from front office to middle office. So you may ask why. So the reason is this: when the portfolio manager is part of front office, they always put a cap of a sales guy. So what we are trying to do here, that we are trying to make them, we are trying to think them through as a credit. So that's why when we move them as the part of middle office as a function of credit, they will put a head of a credit, and that is where it will strengthen your credit organization or the credit unit. So again, no option or the no structure is the perfect one. We try to make it the most effective one, and as option 1 and option 2 and option 3. And if I again go back to the option 1, I'd like to request Bob, if you'd like to share your thoughts. So what do you think about option 1 as a structure?
Take myself off of mute. Sure, I'll just make a couple of brief comments about option 1. So there's a couple things I like about option 1. What I do like a lot is that there's a lot of support for the RM. And again, as we talked about before, trying to give the RM as much opportunity to go out and call on clients and prospects, because really that's where the function should be, and that's where we generate revenue. So there's a lot of support in option 1 for the RM. The difficulty I see with option 1 is we really have three different roles that are servicing the client. And I think, between the relationship liaison, the relationship manager, and the portfolio manager, who is the primary contact for the client under what circumstance might be a little bit confusing for the client as to who they contact. And also, when you look at those roles, what is sort of the delineation of duties, right? Where are the clearly defined roles and responsibilities? And I can tell you what will probably happen in a situation where you have that structure is it's going to be different from office to office. It will depend on how strong of an RM you have and what they delegate to the liaison or the PM. Or if you have a very strong PM and a weaker RM, they may actually take a more lead role in the relationship. So if you're looking for standardization and you have those roles, I think it's going to be harder to do because you're going to have different people with different skill sets. When I look at credit underwriting, sort of the middle office, credit underwriting to me is sort of attached very closely to portfolio management. At KeyBank, we have that as a line of business function. It doesn't report up to the line of business heads, but it is on the line of business side of the bank. And credit really is the standalone. They are strictly there for credit decisioning and of course advising on credits and credit structure. But their primary role is for credit adjudication. In the back office is fine. The more we can move to the back office, the better, because that tends to be the more efficient. But I do like the central support at the front office for the RMs. The more we can support them, like I said, the better results we'll get, hopefully, from their colleague.
Yeah, thank you, Bob. So, Sean, I can understand that M&T also trying to reorganize the structure in terms of the organization level. Would you mind to share your point of view on our option number 2 or option number 3?
Yeah, sure. As I said before, we're in the process of maybe tweaking a little bit of the option 2 and option 3. We're currently in option 2, I would say. I mean, not perfectly aligned with that, but I guess the key portion is the portfolio manager reports to the line right now. And so some of the challenges that Bob mentioned in option 1 also exist in option 2. I think the primary challenge I've seen in the functional alignment of the front office with portfolio managers we're spread across multiple states, multiple cities, what we call multiple regional divisions. And we have 26 community banks. We're spread across that. So you have differences, as Bob mentioned, in the strength of the RM, the strength of the PM, their skill sets, in conjunction with the challenges from the tasks and duties that weren't properly aligned. We see variability across that, variability in management as each individual portfolio manager rolls up to a group manager in a different region. They manage differently, prioritize differently, maybe have different objectives. So I see the variability as the challenge from that, although the line prefers to have the portfolio manager at hand to help them with the underwriting. Also, we find the challenges with this model is there's duplication between loan analysis, which is the underwriting shop that I manage, and the PM. So they do initial underwriting and tasks and term sheets and screening memos, and that's more of a credit function. So what we're really talking about is aligning more in a functional alignment to credit, more synonymous with option 3, where the portfolio manager reports up to credit. And we think functionally aligning the portfolio manager to credit will have some of the benefits we talked about. The primary one you can see from this slide is the front office, the head relationship liaison and RMs. Their tasks and support are primarily going to be relationship driven and sales driven. I think when you get into the other ones, we've seen unclear roles and responsibilities in which the RM takes on multiple tasks. And that gets away from what Bob says is they're our most expensive administration personnel, and they should be really driving relationships, developing relationships, and out prospecting. And how do we reduce the administrative burdens, which is really the first slide that we had on the polling question, which we struggle with on the amount of administrative tasks on our sales force. So, I like the option 3, where the portfolio managers are aligned. We can share responsibilities in both credit functions, and the line is more geared to the line function of sales and relationship development. Also, the back office, we are also defining those roles and responsibilities, because we have a mix of some of option 1 in as well, where the RMs get involved in closings and fundings and with primarily relationship-driven issues and problems, where the back office in option 3 should clearly define those roles and provide more efficiency, both for the RMs and for credit and for closing. And hopefully that drives more efficiency and a better customer experience from the client perspective as well.
Great. Okay. Utpal, anything you want to add before we ask our audience about this?
No, I think nothing more to add. I think Sean and Bob both have shared their organizational experience, and thank you for that.
Well, I love the dynamics of the conversation, and obviously more than one way to bake this cake, as our influential panelists have discussed. Bob leaning towards option 1, Sean more towards option 3. If I didn't get that backwards, I guess I did. But maybe now you guys want to sign in, and then we're going to sort of discuss criteria for selecting, the right model for you. So if you would take a moment to answer this final polling question we have, which of the 3 structures do you relate with? Do you think is best, perhaps? Is it operational test in the front office, operational in the back office, or sort of a back office portfolio manager, middle office kind of structure that our panelists discussed? And if you give us a quick idea of that, we can go ahead and move on to some criteria and some guidance for you folks, hopefully, and get to some questions. I'm jotting down notes. I hope you folks have got questions ready also. And anything we don't get to today, we will follow up with, and you'll get a link to a playback of this session also. So make sure you hit that submit button, please, after you make your choice. And I'm going to go ahead and close the poll now. Okay, well, there you go. It looks like we have a mix of different structures, and maybe who was it? Was it Sean or Bob had it right on the third choice? I'm not sure. I guess it was. I guess it was Bob who preferred structure number 3. So with that in mind, we do have a mix of choices here. Let's move on and talk about, what the criteria should be for picking the model that's right for you. And again, I love that this is horses for courses. It's not one size fits all. So Utpal, what do you think about the responses, and where do you want to take us now?
Yeah, so moving to the slide number 12. So what I'd like to share here that as Sean also said at the start of our conversation, Bob also said that there is no perfect answer, there is no perfect model when we are talking about what is the right organizational structure. But what we can say here that when you are thinking about the organizational structure, there are a couple of key factors which you have to keep in your mind. So when I'm saying a couple of key factors, that as an organization, what's your culture? As an organization, what is your vision or your objective? So something like if you are more in terms of top line driven, or whether you are more in terms of the focusing on the asset quality. So based on that, probably you'd like to move between option 1 or option 2 or option 3. And truly speaking, there can be option 4, there can be a number of options. There is no thumb rule out there. So it's totally based on what you want to achieve, what's your vision in terms of an organization. But what we'd like to put here, when you are choosing for the organizational structure, these are those key factors which you should keep in your mind while you are going for your organizational structure. So Bob, Sean, would you like to share your thoughts on these key factors?
Sure, I'll go first, Bob, if that's okay. No, I agree with Utpal. I think M&T, I've been here for 27 years, very, very strong credit culture, very conservative credit culture over a long period of time. We are, as I mentioned, realigning some of the back office and administrative. We've had a history where the RM in our organization is the quarterback of the whole relationship. So we're a very conservative driven credit culture bank, but also a relationship driven bank. And so the credit culture the RM has been responsible for many, many years and decades, the primary responsibility of that relationship. And I think that's what's really driven the lack of clarity in the roles and responsibilities, really, is because they've been tasked with a lot over the years. As we move into technology and more customer facing, you have to relinquish some of those responsibilities. And I think you have to create reporting structures that mirror that and reflect both the culture of the bank and the operational and risk of the bank. And so going back to my earlier comments, I think the clarity of roles and responsibility is key. That provides clarity to the tasks, and I think provides more accountability. You're able to set better personal objectives for both RMs and PMs. It creates, especially with the introduction of technology like nCino, you're able to have better performance matrix, and you're able to better evaluate people. And I think that's more important. We're going to talk about in a minute is the change management, because when you have those matrix and those clear roles and responsibilities, you're able to change behavior, which is the key portion of change management, whatever model you pick here. And I think with the change management, you can change that behavior, but you create a process that's more sustainable. And I think that's been our experience as we dive into this here at M&T, but my long history at M&T, those are some of my thoughts to reduce some of those challenges.
Okay, great, Sean. And so I'll make a couple of comments just on client experience as well. When you think about how long it takes for an RM to call on a client, generate an opportunity, finally get an opportunity to bid on a piece of business, run it through the credit process, finally get it all the way through to booking and funding. It can be an awful lot of effort and a lot of time, and it's a lot of investment for the client as well. And the last thing you want to do at the end of all that is to have the client regret picking you as a bank because you gave them a bad experience, right? So what do the clients need to make sure we have a good client experience, right? We need to give clients transparency as to where is their request in the organization. How's it going? We need to be able to have RMs know where things are in the process, to set reasonable expectations with their clients to when we can deliver, and then of course to respond in a timely manner. And you need to have an efficient organization. You need to have technology to do that. As Sean mentioned earlier, they've rolled out Encino, and we've done the same thing at KeyBank. And I'll admit, it's not without its pain points, right? And we're getting better as we roll it out to more and more of our units. But what that system does allow us to do is, an RM from the very beginning kicks off a task and describes what they want to do. They upload all of the relevant information. That moves to underwriting. Underwriting spread statements. They do the credit write-up. They do the work they need to do. They forward it on to the credit officer. The credit officer gets notified that there's an item in their queue, right? So they pull that down. They take a look at it. Everything is all there in one file. Certainly have an opportunity to ask questions, but when they're done, they click approve, and then it moves on to booking and to funding, and that file sort of stays in one place. Everybody has access to it. There's full transparency. You can see where it is in the process, and you can even see how long somebody has actually held that request, and if you've got a bottleneck somewhere. So technology can help. I'm not a believer that technology can solve a flawed organization. I think you have to have your organization right and then employ technology. But technology has a place, and it will help to be more efficient in the future. And like I said, Encino's not without its issues, but we're getting better as we roll it out throughout the organization.
Yeah, I agree, Bob.
Great comments, fellas. We're gonna move along here toward, I guess, our last discussion, which is going to be around a methodology for revamping organization structure, and then open it up to Q&A. I love that this discussion. I spend a lot of time in technology discussions, and that's not what we're really doing today. The technology is a part of it, but not the core. So I put us on slide 13 here, Utpal, revamping the rapid way. So maybe you want to talk us through this a little bit before we get to Q&A.
Yeah, sure, Jim. So maybe the question come to your mind, and when we are talking about the challenges, when we are talking about that, how the things should be done, what the benefit of it. So how to approach these challenges, what we should take as a next step to do that. So again, when we are sharing the point of view from our end, it's always based on interacting the multiple slides, and this is as per our way, this is the rapid way. So when we are saying the rapid way, first you have to review your current organization, your current, how you are structured, to say. Then probably based on that, you have to assess that what are the difficulties or what are the challenges, what are the opportunities are there, how you can reorganize your organization. Once you're done with that assessment, then you should come up with a proposal, which will be followed by an implementation. So when we are saying implementation, it should not be a bank-wide one-shot implementation. It should be a kind of a pilot phase. Should be a wave-based. Once you came up with your thought process, you should try to implement that in a couple of sectors or maybe a couple of regions, again, in structure. Then once you're done with that, based on the outcome of your pilot, then you should go for internet rollout. So these are the way you can think of that if you want to go for an organizational change, if you can approach this rapid way.
So, Utpal, I guess I'll chime in on the revamping of our organization a little bit. We're probably out of the rapid, we're probably on the D step. And I would say rapid is, it's not exactly the word for the change because it's slow and methodical. But I agree with the acronym here. And we are on D, on a test and learn now basis for the change in the model. But I would say different than what rapid is you got to take a more slower approach, a methodical approach to the roles and responsibilities and engage a lot more people. Change, no matter how small, it's very difficult. And I think we're in that step. We've taken all the steps. We've process mapped things. And as you take this approach, and the rapid approach here is defined with the stakeholders, the organizational structure, there's challenges all along the way because you have a lot of different personalities, but This is the right way to do it. We've learned a lot through the process and are implementing some of those changes now. I would say on this rapid approach would be do test and learns, do pilot programs, don't do a big bang theory, look for small tasks and get small successes to bring people along. And with the long-term goal of all the positives and all the challenges we talked about in the beginning of this session that can be accomplished. So that's some of my thoughts, Paul.
Yeah, and I can add to that. I can add to that a little bit. So, you know, we over the last few years have changed some of the way we do this. We actually wound up with several different structures depending on sort of the size and complexity of our deals and our relations. And so really we have our what I will call our high touch, high cost model. And that's really full PM support for the RMs. The PMs, you know, they handle the portfolio, they do all the underwriting. In a lot of cases, they're primary contact with clients. They're very professional. And the RMs really are charged with going to find new clients, cross-selling, and a lot of it is investment banking they're trying to do as well. Really, those are for our large syndicated deals. You know, they have to deal with bank groups, the banks, lead deals. You know, our ABL practice is certainly in there, and our leverage finance. Those are very. What I will call sort of our middle ground is our credit campus model. We handle most of our middle market business banking, you know, SBA, private banking. And we have a centralized credit campus that does underwriting support. They do monitoring covenant. You know, they track financial statements. We do reporting. But what they don't do is client contact. That is really reserved for the RM. And the RM receives additional support for administrative tasks really at the local level because the underwriting is sort of is in a central place. Our small business model is our high volume shop. And again, you know, smaller deals, lots of volume, lots of automation for underwriting, and you know, even in our decisioning. And most of those deals come in from our retail finance. So we found that one size doesn't fit all, not even in our organization. It really depends on the type of business we're doing. And KeyBank has a broad spectrum of business that we do. We service a lot of different clients, and one structure is never really going to. So we've gone through the rapid process. We've designed it, and you know, certainly we tweak it along the way. You're never really done with it, but you know, again, we found that one size really was not, or one structure really wasn't appropriate for all of our businesses. Okay.
And Jim, I believe you're on mute.
I sure am. Thank you. I'm the guilty party, absolutely. I'm going to move us on to Q&A. It's a great discussion. Utpal, did you want to add anything before I jump to questions here?
No, thank you for sharing your thought, Sean, Bob. Yes, we really, it may sound like rapid. Yes, we may need to be a bit slow. We have to see the change. We have to come along with all our employees, taking the concern that because this is a change, everybody should be part of it.
Excellent. Okay. I was about to remind everybody to be nimble with their mute buttons, and there I went ahead and violated my own rule. So we're going to have time for a few questions here. Anything we don't get to today, we'll be happy to follow up with you. We'll get you back to business at the top of the hour. So hang with us for the next few minutes. And again, we'll send you a link to the recording of today's presentation, and you can also download the slides from your viewer on the resources tab there. So let's get started real quick. And I'm going to ask the first question. I'll point this one towards Sean. And the question is, what are the typical challenges internally in your bank to horse through this kind of change? Do you expect, well, I'll start you there. What are the big roadblocks? And again, I'll ask everybody to be nimble with their mute buttons there.
Sure. Thanks, Bob. So as I mentioned, any level of change is difficult. So change management just by nature is difficult. I think as I've seen, people have a tendency to look at the negatives and not the long-term positive benefits and maybe some resolution of the challenges we discussed today. They have a tendency to focus on some of the short-term problems. I think typical challenges in change management is, more of an us versus them. When you switch reporting roles, when you switch structural changes, there's people that obviously have to give up control. In some of those models that we talked about, option 1, 2, and 3 is, maybe the RMs, the PMs report into the RMs. They feel that they've lost control, that they've lost their support, even though sometimes the challenges that we talked about are so overwhelming, and that a new option would be more beneficial. So you have a control, you have a change in job grades, you have change in incentive programs, you have reporting requirements, training requirements. I think a lot of the challenges have been in reporting structures. When you tell somebody they're going to report to somebody else, that's kind of a challenge. And the other thing is, my earlier comments about the rapid is the test and learn is you have to do all this stuff and change internally with no impact on the customer. So that's the biggest challenge, that's what everybody has to keep in mind, is that there is a customer. We're redesigning this because something was not working, whether that was sales or credit or both, credit officer. And, combined, when you make these realignment and changes, there's a lot of benefits that come out, both from a customer experience and employee experience. But some of the challenge, I would say, the HR challenges are difficult, but I think they're not insurmountable. But, often in times they lead to opportunities for people as far as promotions, team leader, opening up the organization, and that's what we're seeing now.
Yeah, I think the HR function is important because people are rewarded by performing to the level and the goals of the tasks that they understand mark their success or not. And some of the process changes here can definitely take that away. Okay, I'll ask folks to keep answers a little bit short so we can get through a couple more before we close. Utpal, if there is no separate portfolio manager role along with the relationship manager, what do you suggest in terms of structure and responsibility in terms of a model to follow?
Mm-hmm. So, so let's assume if you don't have portfolio manager, okay. So probably what you can think that if you think about that you have a portfolio manager in the system, it means they are performing a particular specific job or they have some responsibility. So if you do not have portfolio manager in the system, it means the jobs which are assigned to them, the jobs which they are performing, someone else needs to do it. So whether it is first your front office or whether it is middle office. So what you have to think that who is the best person to do those jobs, whether it is again front office or whether it is middle office. Probably if a portfolio manager in our model in option 1 or option 2 or option 3, they are playing a role of a client interaction, those jobs should be associated with the relationship manager. It means you take out the job and based on the right skill set, you just map those things based on whatever the designation or whatever the structures which you have internally. So whatever the client relationship activities are there in your bank, that should be part of your relationship manager. And whatever is related to the credit, that should be mapped with your middle office where the credit function is live. So you can think on those lines, okay, if I don't have a portfolio manager, someone needs to perform those tasks. So based on the right skill set mapping, based on the tasks which should be done as per your right organization, you should align them accordingly. So if you have, obviously you should have relationship manager, so they may take care of the relationship part. If they obviously will have a credit shop, they will take care of the credit part. So that is how you can think of that. If you don't have a portfolio manager, that how you will distribute those tasks according to your existing structure.
Excellent. Okay. I'm going to direct the next question towards Bob here so we can pass things around a little bit. Bob, in your experience what is the best way to drive these kinds of changes, specifically in the implementation upfront, in the implementation phase, or what are the things that should be kept in mind when you're going through implementation?
Yeah, just a couple, and I'm going to be very brief because I know we're running out of time, so I'll just abbreviate this quickly and just try to mention a few things maybe that we haven't talked about. You know, clearly you want clearly defined roles. We have talked about that, but that's just so important. But the other thing we haven't talked about is you got to have good, solid credit policies and procedures, and you have to write them down. They got to be accessible to everybody. Everybody trained on them. Everybody needs to understand them. So everybody has a clear understanding of what is expected. And what you don't want to do is things like, you know, that's the responsibility of the line of business. Well, that's not specific enough. You need to say who is responsible for that task, so everybody understands how they fit into the organization. And the other thing I will say is, you know, you want quality control. You got to go back and make sure things are happening the way they should. People don't backslide and go back to the old way of doing things. But then finally, what I'll say is you also have to be flexible. There are times when no matter what structure you put in place, there are going to be times when you have to operate outside of that structure. You have a rush request. You have a special situation. Be flexible, but don't let people use that as an excuse to backslide to the old way of doing things.
Excellent. Okay. Lots of great advice today. You know, we could definitely spend we could spend another hour or more on this, but we're out of time, and I promised to get everybody on their way today. So I want to thank our distinguished panel for their excellent, forthright comments today. Sean Timms, Group Vice President for Loan Analysis at M&T Bank, and Bob Zeller, Head of Banking Group Portfolio Management, and Utpal Sengupta, the Head of Commercial Lending Practice at WNS. For American Banker, I'm Jim Erickson, and I want to thank everybody here today for sticking with us through the presentation. We'll get that link to the playback to you as soon as possible. And with that, I'm going to end our conversation today. Say so long, everybody. Thank you, and have a great week. Bye-bye.